If you're a relative beginner in options trading, there's one mistake that can ruin any chance of you making it as a trader. In this video, we'll reveal what it is so you can avoid it and have a real chance at success. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to develop numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a professional proprietary trader on our desk so you can grow your trading account.
Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And one of the most gut-wrenching experiences for us as a proprietary trading firm is when we're working with traders who clearly are bright and talented, enthusiastic, all the traits necessary for a potentially great trader. And then almost out of the blue, the trader makes a catastrophically stupid decision that not only blows up the trader's account, but permanently derails his entire trading career. And the worst part is that these decisions are completely avoidable. And had the trader not made it, he could well have gone on to become a solid full-time trader with all the rewards that come along with that. And you're going to be shocked at how simple it is to avoid this error. And the purpose of today's video is to warn you about this mistake and to basically beg you to not make the same mistake yourself, because I know how it's going to go, and believe me, it is not going to end well. In order to explain to you this awful trading mistake, if you're absolutely brand new to options trading and you don't know that much about options or how they work, we've created a video for you to understand the basic option strategies. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand what we're going to be sharing with you in today's video. Then when you're finished, you can come back and watch the rest of this video. Okay, so the way that most professional options traders make their money is by employing a strategy that has long-term edge and then repeating it over and over again, repeatedly, with the faith and experience to know that while there will be both winning and losing trades, that the strategy, if you're disciplined and persistent, should provide the trader and the prop firm with superior profits over time. And so I'm going to show you an example of a very commonly employed option strategy. So let's head back to the final day of March last year in 2023, the final day of the first quarter of that year. And as you can see, the S&P 500 index closed that day at 4109.31. Now, let's suppose that you had done some research and found that a certain option strategy had long-term edge, and so you had determined to trade that strategy on a modest amount of capital for a quarter to see if the research you did would be supported by the actual facts of implementing the strategy live in the market. And so you went ahead near the close that day and you pulled up an options chain that expired a week later on April 6th and looked at the column called Delta, which will be a column that you'll have available to you on any professional options trading broker platform. And you looked first on the call side for an option that was closest to the 10 delta, which in this case was the 4200 call, which had a delta of 8.87. And he sold 2 of those and then went down to the put side and found the 4000 puts, which had a delta of 9.74, and sold 2 of those. And then for protection, he bought 2 of the 4250 calls, 50 points above the 2 short calls at 4200, and he also, for the same reason, bought 2 of the 3950 puts, 50 points below the 2 short puts that he sold at 4200. And so when he's constructed this formation, short calls above the market price of the index and short calls below the price of the index, surrounded by an equal number of long calls and long puts farther away from the market price, when he does this entire combination, he is said to have executed a 10 delta iron condor using SPX index options. And this is a pretty common option strategy deployed by options traders all over the world. Now, why would he do this? Well, the reality is that this trade has an approximate 80% chance of being profitable. And that's certainly a good start. And a little later on the video, we'll explain why I say that. But for now, just accept that a trade with that kind of likely win percentage is something an options trader would typically take pretty seriously, and you're going to see why in a minute. Now, before we see how this trade came out, it's important to understand the cash implications of what we've just done. And so when we sold those two calls at 4,200, they were priced at $2.60. But remember, index options pay off at a rate of $100 per point that the index closes beyond the strike price of the option. So you multiply that by 100 and you sold two of those. So the total cash inflow you received from those 4,200 calls was $520. And using the same kind of calculation, you bought the two 4,250 calls for $100 exactly. And as you also sold the 4,200 puts for $820, but turned around and bought the 3,950 puts for $346, which, when you net it all down, results in initial positive cash flow into your account of $894. And your broker will require you to have at least $9,106 in your account to execute this trade, incidentally. But if you want to trade it smaller, you just reduce the lot size and the capital requirement comes down proportionally, obviously. So now let's move to the day this trade expires, which is a week later, as we mentioned, on April 6th. And as you can see, the index had stayed pretty flat that week and closed just about where it was on the day when we entered the trade, closing at 41.0502 that day. Now, once options expire, you can place a final value on them, which is going to be easy in this case, as you'll see in a minute. And so starting with the cash flow we initially received for selling the Iron Condor in the first place, that $894, when we look at the 4,200 calls we sold, we'll realize that those expired about 100 points higher than the index closed. And since call options only pay off when the index closes above their strike prices on expiration day, that obviously doesn't meet that criteria, and therefore it expires with zero value. And the same is obviously true for the 4,250 calls we bought above that. And similarly, the puts only pay off if the index closes below those. So both the 4,000 and 3,950 puts expire worthless. And so the only thing left is that initial cash flow that we got when we first sold the options. And we get to pocket that for our $894 now profit. Okay, so that trade is over. And at this point, I'd like to now explain why I said that the trade had approximately an 80% chance of giving us this result in the first place. So first of all, let's focus on the fact that the options in the last example, the fact that they expired worthless was actually a good thing, a very good thing, right? Because if we get cash in the beginning and the trade ends with none of the options having to pay anything off, then we just ended up with that initial cash flow as our trade profit. So then what we're really saying is that this trade has an 80% chance of all of its options expiring worthless. I mean, isn't that really what we're saying? And how do I know this? Well, remember, the options we sold were closer to the index's price than the options we bought, and the options we sold had a delta of 10 or less because we looked for those and sold those. You see, the delta of an option is a mathematically arrived at prediction of how much an option's price is likely to move based upon how much the index itself is moving. And while it's a bit of a complicated topic, suffice it to say that an option's delta has also been found to be highly correlated to the probability that an option will expire with value on the day it expires. And so the 10 delta option has approximately a 10% chance statistically of expiring with value. And so if a call option is 10 deltas or less, then it has a 90% chance or more of expiring worthless. And if a put option's delta is 10 or less, it also has a 90% chance or more of expiring worthless. And since the short calls and puts are both 10 deltas and the long call and long put are even farther away from the market and have an even less likelihood of expiring with any value, then really all four options have less than a 10% chance of expiring with any value at all. And since the calls are above the market and the puts are below the market, then combining them into the same trade means that all four options have less than an 80% chance of expiring with any value at all. And that's why the trade has such a high win rate, which makes common sense, right? The lower an options delta is, the farther it is from the market when the trade's initiated. So it's natural that in many cases, none of the options will expire with any value because the chances were so low from the beginning. And so remember now, this is all part of a campaign that is done repeatedly. So let's now move to the next trade, which we put on immediately after the first one expires and our capital gets freed up for the next trade. And so now this time the 10 delta calls happen to be located at 42.10 and the 10 delta puts were located at 39.80. And of course, again, we're buying protection 50 points farther out. And so our iron condor looks like this. And the cash flow analysis looks like this with a positive cash flow of $1,274 in this example. And so moving again forward to the day that this iron condor expired, we can see that the index had rallied a bit up to 41.37 on the day this iron condor expired. And just like the previous week, the index expired between all of the options, below the calls and above the puts, which resulted in the same outcome, that being that the cash flow we received at the beginning of the trade becomes our trade profit. And so we do this repeatedly throughout the months of April, May, and into June. And so as not to be too repetitive in this video, we created a scorecard of the outcomes of the trades, which you can do yourself at home if you have backtesting software and I guess insomnia one night. But if you'd like a shortcut, you could just look at the scorecard we put together. And as you can see, starting with 2 trades, we already reviewed the wins on the April 6th and April 14th trades. You'll notice that the strategy actually had an incredible winning streak that quarter. And the first 10 trades of the quarter were actually all wins, totaling $9,718. And so at this point, the novice trader might be thinking to himself, hey, you know what? Here's a trade that's been making on average $971.80 a week for 10 straight weeks. And it's never had a loss. I mean, we're talking almost $1,000 a week. And all we need to do is put on this iron condor every Friday afternoon and boom, like magic, I pocket $1,000. I don't even have to close the trade. I just let it expire and then I'm $1,000 richer. Well, I must be crazy for trading it this small. I mean, I have a lot more free capital than the $9,000 or so I needed for each of these trades. I mean, just imagine, had I traded this with a 20 lot instead of a 2 lot, in other words, if I traded this 10 times larger, then I would have made $97,180 in about 10 weeks. I mean, this virtual ATM machine would just hand me $10,000 a week for doing almost nothing. So I must be crazy for not trading this larger because I'm sitting on a gold mine here, right? And so he funds his account up to $100,000, and on the next trade, he executes a 20 lot instead of a 2 lot. Now, I know some of you out there are a little squeamish, and so we're going to be issuing a trigger warning to you right now for those of you who may have had a similar traumatic event in their life. And so you've been warned, and you need to make the conscious decision as to whether you want to continue watching this video or not. And just to create context here, we had just completed our June 9th trade when we had this revelation that we should start trading a lot larger and turning our weekly $1,000 paychecks into $10,000 paychecks. And so we went ahead and put on a 20 lot iron condor with the short calls at 43.90 and the short puts at 41.90 and surrounding it again with protective options 50 points farther away from the market as always. And as you can see from the calculation, this time we're collecting $9,200 for entering into this trade. And I mean, now we're talking, right? Now we're getting a really huge payday. And even though our broker will be requiring us to put up $90,800, well, we took care of that, right? We funded our account up to $100,000 because now we got smart. I mean, we can make in 1 week just about what we made in all of the previous 10 weeks. We finally woke up here, right? Okay, so now let's move forward to the day this iron condor expires. And as you can see, SPX had a little stronger rally than normal, and it closed for the first time all year above 4,400, with the iron condor expiring as the SPX closed at 4409.59. And so let's take a look at the outcome of this trade. And as you can see, this time it's a little bit different. And that's because in this case, the index closed 19.59 points above the short calls. And the reason why this is such a big deal is that you almost could have forgotten that when you sell an option and the market closes beyond the strike price of the option, then you're on the hook for paying off $100 per point beyond that call strike price, times the number of lots that you're short that option, which in this case is 20 lots. And so as you can see from the math, the 4390 calls are required to pay out $39,180. And even though all of the other options expired worthless, even when you kick in the initial cash you received for selling the Iron Condor, you still just dug a $29,980 hole for yourself. And so when you go back to update your scorecard, you realize that you just blew up your entire campaign with a horrible $20,260 loss, including the 10 wins that preceded it. And you now have an average loss per trade of $2,026.20, even though you won 10 out of 11 trades. Now, at this point, I can tell you from experience, I have never met the trader that can psychologically recover from this. Almost everyone who has gone through such a traumatic loss ends up quitting. They lose complete faith in their well-researched system. They curse the day that they ever heard of options trading, and they immediately start sending out resumes for whatever career they were trained in before they started trading full-time. That same career that, by the way, they were trying to get away from and gravitate towards trading. And to drive home just how stupid this decision to suddenly trade 10 times larger than he was trading before was, when we went through and finished the quarter through to June 30th, assuming he somehow didn't quit trading and instead went back to trading 2 lots, it turns out that the June 23rd trade would have been at the normal 2-lot level, a win of $726, and the June 30th trade was also a loss, but on a 2-lot, it was far less damaging loss of $3,278, resulting in a final campaign outcome of negative $22,814. But had we stayed at the exact same 2-lot level the whole time like we should have, the June 16th loss would have been just $2,998, and the total outcome of the campaign would have been a positive $4,168, which translates into a return of around 44% for the campaign against the peak capital that your broker would have required for a 2-lot Iron Condor any one of those weeks. And so you might be out there asking, hey, okay, I get it. You can't go on a winning streak, generalize that this strategy is so great it can never lose, jack up your capital level, and then get slaughtered. But hey, Seth, does that mean we're always stuck at a 2-lot level and can never increase our capital level? And obviously, prop firms couldn't exist and thrive if all the traders were just trading 2-lot Iron Condors. Of course you can increase your capital. And with great systems, you should increase your capital, but not like that. A 10-fold increase because you completely lost perspective and assumed that your winning streak was going to go on forever is ridiculous. What I suggest to all of the traders that we train is instead to think of options risk as a muscle that you must build very gradually and slowly in order for it to become strong. Because at the end of the day, what we're talking about is psychological strength. But you can't literally traumatize yourself by creating a loss that dwarfed all of your gains by sizing up too quickly. Instead, you should size up very gradually. So perhaps after 1 quarter at the 2-lot level, you go to 3 or at most 4 lots, and then keep track of how you feel after a loss at the new higher capital level. Obviously, we're human and no one's happy after a loss, but did the loss at your new lot size cause you to waver and lose faith in your research, despite how solid it may have been? If you truly were fine with the loss and understood it to be part of an otherwise solid system, then you can continue to very gradually increase your capital level over time, staying at each level for a fairly extensive period of time until you move to the next level. In fact, a best practice is to not increase your capital level. I know this is going to sound funny, but I suggest to people you don't increase your capital level until you've experienced at least 1 loss at your current level so that you can keep checking in with yourself psychologically to make sure that you are stable after a loss at the new level, which is going to be a larger loss than you've ever experienced because you're now at a higher level. So as a rule of thumb, you never want to increase your capital level after a long winning streak when you're feeling cocky. Instead, it's actually better to bump your capital level after a loss. And of course, do so gradually. That will surely be a more sensible way to grow your trading account in a solid, gradual way instead of getting cocky and blowing yourself up before you ever got to prove to yourself that you could have been a great trader in the long run. So please remember this and give yourself the best possible chance to have a successful trading career.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.